And joining us now is James Knightley. He's a UK economist at ING Financial Markets. James, thank you so much for joining us. Now, UK November jobless claims falling by 6,300. We were forecasting a 12,000 gain. Better news.
It is. It's remarkable figures on the labour market, really, that we've seen over the last few months, because not only is unemployment seemingly falling, but the employment data from the ILO of the previous couple of months has actually shown a rise. So if we look at an international comparison, for example, the US has lost about 5.5% of all its jobs. The UK, which has actually contracted far more, has only lost about 2% of its jobs. So the resilience of the UK labour market is quite remarkable in this downturn.
And this, of course, is the first time that UK claimant counts actually falls since February of 2008. Now, talk me through the general picture, James. On the one hand, we have this rising inflation. We have this better than expected employment number. Does it mean that we're starting to see a recovery?
I think we are. I mean, the lead indicators we've been getting are all pointing to growth, particularly the purchasing managers indicators. So it is very encouraging. But I think the inflation fears are somewhat overplayed. Certainly inflation is going to probably push up above 3% on oil prices and the VAT hike. But we have to look at where the labour market is. While today's numbers were better, we've still got a large number of people unemployed, and wage rates continue to be very, very low. And that, over the medium term, does suggest that given the spare capacity in the economy, inflationary pressures are pretty benign. And then if we do have to consider higher taxes and less government spending, then the recovery is likely to be pretty slow as well.
James, does this mean that the employment picture is just going to get better, or could this just be a one-off for the month of November?
Well, the last couple of months have been pretty good, beating expectations. But I'm a little bit concerned that with government finances coming under pressure, we could see employment levels in the public sector start to decline somewhat through the latter part of this year, and particularly through 2011. So while the private sector numbers are looking a lot better at the moment, I am concerned that the public sector employment figures may lead to a renewed downward leg over the next 6 to 18 months or so.
James, I just wanted to bring up today, I mean, the pound has been rising against the dollar when we had those figures. 10-year gilts also on the decline, yields rising to around 3.91%. In terms of where you see this going, what can the Bank of England now do? Is it in a stronger position to actually start withdrawing stimulus?
I think there is going to be growing pressure on them to do that, particularly if the lead indicators continue improving, the labour market is improving, and inflation, as I said, pushes up above 3%. We could see those expectations for interest rates to increase over the next couple of months. But I think, once we get past this spike in inflation and we look at the underlying fundamentals of the UK economy, where household sector is still incredibly indebted and wages are still pretty low, and there's going to be higher taxes and less government spending, then I think that the Bank of England has got room to keep policy pretty accommodative through until the second half of next year.
So when are we going to start seeing interest rates rise?
Well, we think late third quarter 2010 with a further hike in the fourth quarter. But to be honest, given that fiscal policy tightening is going to be doing a lot more of the work relative to monetary policy, I think the eventual peak in UK Bank of England rates is going to be a lot lower than we've seen in previous cycles, maybe, say, 3.5% to 4% rather than, say, 5.5% to 6% in previous periods.
All right, James, great to speak to you. Thank you so much. James Knightley there from ING Financial.